na panahon ng pagkakataon, may babalik bang kahapon?
Good day, everyone, and welcome to our virtual classroom. My topic for today is about depreciation. This is for intermediate accounting. So if you are new to accounting, if you are an incoming first year BS Accountancy, BS in Business Administration, BS in Information Technology, I suggest that you check my discussion on the basics of accounting and the adjusting entries. So, in my previous discussion, any item that has future value are stays in an asset account. Then eventually, we transfer that when we consume or as time passes, we transfer that item to an expense account. So all of these assets, especially property, plant, and equipment, except land, has its time limit. So normally, these are usable for a number of years. So after which, they have relatively of little value for service or sale, or if not, zero. We have different names for that expenses depending on the associated assets. So the concept for this depreciation, depletion, and amortization is the same. So it depends on which asset it is associated. For tangible assets, mga assets na nakikita, nararamdaman, nahahawakan, property, plant, and equipment, the expenses are called, the allocation of that expenses are called depreciation. For wasting assets or natural resources, assets na nauubos, nawawala, depletion ang tawag. For intangible assets, hindi nahawakan, hindi nakikita, hindi nararamdaman, amortization. So para mas madaling tandaan, isipin mo na lang ang mga expenses or pinagkakagastusan mo doon sa mga minahal mo dati. Depreciation ang tawag pag nakikita or nararamdaman pa. Depletion naman ang expenses pag unti-unting nawawala. At amortization yung mga sinayang mo nung mga panahong hindi mo na siya nakikita. Di ba? Mas madaling matandaan. Okay, next. So, let's discuss how we compute depreciation. So, depreciation by definition, it's also the formula for computing depreciation, where depreciation is the allocation of the cost or depreciable cost of the asset divided by or over its useful life. Okay, again, depreciation is the allocation of the cost of the asset over its useful life. When we say depreciable cost, it's the acquisition cost or the construction cost minus the salvage value. Salvage value is also known as the scrap value. At the end of the year, you can recover some amount from its scrap value. So we deduct it from the cost of the asset to come up with the depreciable cost. Okay, so let's proceed with computation of the depreciation rate. The most common method of computing depreciation is the straight line method. Straight line meaning we get the same depreciation expense amount every year. The annual depreciation is computed by dividing the total depreciable cost, meaning cost minus salvage value, over its useful life in years. So again, annual depreciation is equal to depreciable cost over its useful life in years. Then we will get the depreciation expense per year. The best example for assets that this depreciation rate is applicable are your buildings. When you construct a building, say in 2012, the same value, the same benefit, the company is getting out of that building, out of the investment they had from the building. So straight line method is the most appropriate method of allocating its cost over its useful life. But there are types of assets that are effective or most productive in the early parts of the asset life. So therefore, for this type of assets, straight line method is not the best method of computing depreciation. So meaning it's not the best method to match cost with its corresponding revenue. So one method that will solve that issue is the working hours method, where we get the depreciation per hour based on the estimated total hours that an asset is usable. So this method is usually best for assets like machineries. Okay. Another method of computing the depreciation rate that is similar to working hours method is the output or the production method. So depreciation per output is computed by dividing the total cost over the useful life, now in terms of the estimated total output it can produce. The most common or the best example for this method is a copier machine. Okay, let's apply those formulas in this problem. To make the most out of this tutorial video, I suggest you prepare your paper, pen, and calculators. Pause this video, solve this on your own, then go back to this video, play, and check your answers. That way you are practicing. So you're getting more out of this video by practicing. So let's proceed. Quarantino Company purchased a machinery at the cost of $845,000 on January 1, 2019. It was estimated that the machinery has a residual value of $45,000, or the scrap value. All of its life in years, 5 years, in service hours, 80,000 service hours, and 100,000 based on units to be produced. Okay, so we will be using those three depreciation methods that we have learned just now. Okay, so you have here your operations, hours, and units produced. So first we will use the straight line method. So in straight line method, depreciable cost is divided in the number of useful life in years. Then you will get the annual depreciation. So it's 845,000, the total cost, minus 45,000, the scrap value, divided by life in years, which is 5 years. So our annual depreciation is 160,000. So if we plot that in our depreciation table, so you will get this. So you put the years here, depreciation, or the depreciation expense per year. That's why it's called straight line. So it's straight 160,000. So take note, we only allocate 800,000 over its useful life. That's the depreciable amount. Accumulated depreciation, or the total depreciation per year. So year 1, 160, Year 2 is the total of these 2 years, 320. Year 3, 480. Total of these 3, and so on. At the end of the life of the asset, its carrying amount is equal to the scrap value or the unallocated portion. Okay? It starts with the cost and it ends with the scrap value. So that's for straight line method. Straight depreciation expense or uniform depreciation expense each year for the entire years of the asset. Then we have the working hours method where the total depreciable cost is divided by the total hours expected to be served by this machinery. Okay, so our depreciable amount is 800,000 divided by 80,000 total expected hours for this machinery. So you get 10 pesos per machine hour. Okay, so you get 10 pesos machine hours. So now for this entire for all these years, so number of hours times depreciation rate, which is 10 pesos, we get just now is equal to the depreciation expense for that year. Then for 2017, 17,000 times the depreciation rate, and so on. Depreciation now it's 170, 180, 170, 180, 150, 120. The concept is the same with accumulated depreciation. Year 1, this is year 1 plus year 2. This is year 1 to 3. Carrying amount is the same. Let's start with the acquisition cost. Carrying amount minus the depreciation expense is equal to the carrying amount of that year. So 665,000, for example, here, minus the depreciation for 2020, which is 170,000, your remaining carrying amount is 495. Likewise, for 2021, 495, the beginning of 2021, 495 minus 180 here. For 2021 depreciation, you will get the carrying amount of 315. And as always, the last year's carrying amount would be equal to the scrap value. And lastly, depreciation based on the output method. So again, depreciable cost divided by the estimated total output. So 800,000, the depreciable cost. Our expected units in our problem is 100,000. So we will have 8 pesos depreciation rate per unit. So units produced per year times the depreciation rate per unit, you will get your depreciation for that particular year. So units produced in 2019-22 times 8, you will get this depreciation expense. Likewise for 2018, 2020, 2021, 22, and so on. So these are your depreciation expense. Accumulated depreciation is the same this year. Then this 2020 is equal to 2019 plus 2020 depreciation. So 2021, again, depreciation for 2019, 20, and 21. If you observe, your carrying amount is still 45,000, which is equivalent to the scrap value for this machinery. So stay tuned for the continuation of this video tutorial. We will be discussing another depreciation method which is the sum of the year's digit. So straight line method, production or output method, as well as using the expected number of hours in allocating the cost of the asset over its useful life. So this time, we will be discussing other methods, particularly the sum of the year's digit. We will be using the same problem, so that it's easier for you to compare the difference between those methods previously discussed. So we are still using Quarantino Company as our example. The same cost, 845,000, residual value 45, useful life of 5 years. These service hours and units to be produced will not be needed anymore. And it's still purchased January 1, 2019. There are assets that produces more in the earlier part of its useful life. So for example, when you purchase car to be used as a taxi or for rent, car for rent, we are expecting that these cars will produce more income in the earlier part of its useful life as lesser repairs are required. So cars are expected to be operating efficiently when newly purchased. Parang X mo lang yan. Pakitang gilas sa una, kalaunan, nagbabago. Nawawala ang performance and eventually, talagang wala na. Wala na. Nawawala na. Okay, let's continue. Sum of the year's digit method. Okay. It is called the sum of the year's digit because we are using the sum of the year's digit. To better understand it, let's look at this example. Say, if we purchase a car that with a useful life of 5 years, it's just an example. I know some of you are using your cars for 10 years now. Sana all my car. Okay. For example, the useful life of a car is 5 years. In 2019, its useful life is still 5 years. After a year, its useful life is now 4 years. Diba? Kailangan natin calculator? Sakla. Sige. 2021, 3 years. 2022. And so on, 2023. Our sum of the year's digit is 15. The method we will be using is it's called the sum of the year's digit because the sum of the useful life is the denominator and the useful life here is the numerator when we allocate the cost of the asset. So we create a fraction. Again, this is the numerator. This is the denominator when we allocate the cost. So our fraction there is 5 over 15, 4, 3, 2, 1 respectively. Let's use this in our problem. In 2029, we will be using 5 over 15 times the depreciable cost. Okay. Let's make it clear. Its acquisition cost is 845,000. We subtracted the 45,000 scrap value or salvage value. So we get the 800,000. We are still using 800,000, the depreciable cost. There are other methods of depreciation where we are using the acquisition cost instead of the depreciable cost as our base. Okay, let's discuss that in part 3. For now, let's stick with the depreciable cost. Okay, so 5 over 15 here in year 1 or 2019 times 800,000, that's 266. So that's your depreciation expense for 2019. So the same with our method, accumulated depreciation is depreciation for the year. Then this is depreciation for year 1 and year 2. Then this is depreciation for year 1, 2, and 3, respectively. Okay. So since we are allocating the cost of the asset, the depreciable cost, at the end of its expected life, the carrying amount is still equal to the scrap value of the asset. So I hope I made clear the fractions we are using based on the sum of the year's digit. Okay, so again, we use sum of the year's digits for assets whose performance are better in the earlier part of its useful life. So we are just doing a proper matching of the revenue generated versus the cost of the asset. So if you can see here, higher depreciation are charged over in its early part. Sorry, higher depreciations are charged at the early part of its useful life, and vice versa, lower depreciation are charged at the later part of the life of the asset. Okay, let's continue. How about, how about assets with an estimated useful life of 20 years? If we go back here, computing the SYD, we have to add 5, 4, 3, 2, 1. So how about it's 20 years? How about if it's 50 years? Okay, again, you can be smart. You can be hardworking and you just write there 20, 19, 18, 17, 16. Or we will just ask the help of the mathematicians to come up with we will just think those mathematicians who came up with this formula to solve for the SYD. So their formula is SYD is equal to life, or the estimated life of the asset, times life plus 1, constancy 1. Life times life plus 1 divided by 2. So you have two constant here, 1 and 2 here. So life times life plus 1 over 2. So applying this concept in our previous example, so your SYD is sum of the year's digit. The sum of the year's digit here is the denominator. Okay, again. So we have, in our example, it's 5 years. So it's 5 times 5 plus 1. So it's 6. Times 5, 30 over 2 is 15. Okay, so now let's try for 20. So it's 20 plus 1, 20 times 20 plus 1 over 2. So that's 210. Okay, let's continue. Sum of half year's digit. How about if our problem is, we'll be using the same concept, the same company, except Quarantino purchased a machinery for 845,000 with an estimated useful life of 5 years. So how are we going to allocate the 0.5 here? To solve this problem, we have to multiply its life by 2. So we have to multiply its useful life by 2. So we now have 2 times half years times 2 is, sorry, 2.5 years, which is 2.5 years, times 2 is 5. So you now have to use 5. Then going back to our depreciation, again, um, we just use the doubled life. This is now the doubled life. Then we will compute again the SYD, so we will be getting again 15. Okay, but the difference here is, remember, the life of the asset is only 2.5. We just doubled to allocate for this half-life, for the 0.5 years there. So the effect is, in 2019, our depreciation is, it's 5 over 15 times 800, which is 266. And another fraction, 4 over 15 times 800,000. So you will be using 2 fractions. So our depreciation is 480. So although we multiply our original life, which is 2.5 by 2, but we are using 2 fractions to allocate the cost of the asset. Okay, so in 2020, we'll be following the same. 3 over 5 and 3 over 15 and 2 over 15 times the depreciable cost. So you have the total depreciation for that year is 2,667. So remember, the life of the asset is only 2.5. So 1 year, 1 year. So we have only 1 fraction left. Okay, so you have 53,333. So that's how we do SYD if our assets has a half-year life. No, okay, or life with uh, a decimal point. Okay, how about those? How do we apply SYD if the asset is not purchased on January 1? So we will be using fractional depreciation. Again, we will be using the same problem, so it's easier for us to compare those different depreciation methods. This time, Quarantino Company. Okay, let's go back to the original 5 years life. We will be emphasizing the date it is purchased. So this time, the machinery is purchased on July 1. So how do we use SYD for this setup where the asset is not purchased at the beginning or end of the year? So what we will be doing is, again, we solve for the SYD. So it's still 5 years. So our sum of the years digit, which is the denominator of the fraction, is 15. Then we will go back to our depreciation table. In 2019, we purchased the asset on July. Therefore, we can only record depreciation from July to December. So our depreciation for 2019 is 800,000 times 5 over 15, but times half, because we can only record depreciation from the purchase date, which is July, up to December. So our depreciation expense is 133 for 2019. For the year 2020, our 5 over 15 fraction is only used half of the year. Therefore, in 2020, we have to use the other half. That's for January to June. And we will be using the next fraction, 4 over 15, for July to December. So for 2020, you now have two parts of depreciation. 1334, the balance for this fraction 5 over 15, and the first half of 4 over 15 here. So the total depreciation for the year is 240,000. So in our income statement, the depreciation expense that will appear is 240,000. So our accumulated depreciation here is previously 133 plus the 240, so it's 373 here. And your carrying amount here is previous balance less depreciation for the year of 240, so you have 471,066.67. Okay, so the same will happen in 2021. The balance 4 over 15 will be used first half of the year, January to June, and another fraction will be used, the 3 over 18. So we have two parts again of depreciation. Add this to get the depreciation for the year. The same will happen in 2022. The balance 3 over 15, then we will be using the next 2 over 25. The same in 2023, 2 over 15. Since 1 over 15 here is only half of the year, so we have to continue this depreciation up to 2024. So that's what we'll be doing when we purchase the asset between calendar dates, meaning not January 1, not December 31. So thank you very much for watching our videos. Hopefully you learned something from our video today. And you stay tuned for part 3 of our depreciation discussion, where we will be discussing other depreciation methods, other accelerated depreciation methods, as well as disposal of assets and change of depreciation methods. So thank you very much. Back to our discussion. We are now in the part 3 of the depreciation series. And let's start with the double declining balance method. Let's go straight to our problem. As promised, we will not bore you with the lengthy theories. So Bangon Company purchased a factory equipment into service January 1, 2020. Cost 1,550,000. Useful life 5 years. Method double declining balance. Residual value 50,000. And our task is to prepare a depreciation table. Okay. Depreciation table. So let's start. It is called double declining because we simply double the straight line rate. So to get the straight line rate, it's just 1, a constant, or 100%, divided by 5 years. So that's 100% divided by 5 years, which is the useful life. That's 20 years. Then we double it. So our double declining rate, or our fixed rate, sorry, is 40%. So let's construct our depreciation table. If you will observe, here in 2020, our depreciation base is the cost, the purchase price, total purchase price, and not the depreciable cost, which is cost less salvage value. So that's the one difference of the double declining balance versus our straight line method, output method, and the SYD, which we previously discussed. Okay. To get the most out of this problem, again, the same concept is used in the 150 percent balance. So this is double declining, so that's 200% or times 2. The same concept is applied to 100%, 150% declining balance. So let's go back to our problem. In 2020, our depreciation base is 1,550,000, which is the cost, times the double declining rate, 40%. So you will have a depreciation of 620,000. So since it's first year, the accumulated depreciation is equal to the depreciation expense for the year. So our new carrying amount now is 1,950,000, which is 1,550 less 620,000. For 2021, so we will now use the new carrying amount, which is 930 times our fixed rate of 40%. Our depreciation is 372. So like our sum of the years digit, the double declining balance is also part of the accelerated method, wherein higher depreciation expense are charged in the early part of the useful life of the asset. So it's 372 now, lower than our first year depreciation. So our accumulated depreciation for 2021 is now 620 plus 372. So 992. Our new carrying amount now is 558,000. So the same in 2022, 558 here. Then that's our base times 40%. Depreciation, 223. As expected with accelerated method, it's lower than the previous year. So our accumulated depreciation now is 1,215,200. So our new carrying amount is 334,800. So 2023 likewise, the same. The carrying amount here times 40% to get the depreciation of 133,920,000. Okay. Our estimated life for this property or for this equipment is 5 years. So in the 5th year, there's a slight change. Remember, in the double declining balance, at first we disregard the salvage value. So this time, in 2024, remember that at the end of the life of the asset, its carrying amount would be equal to its salvage value. So that means our total depreciation here and the accumulated depreciation should only be equal to 1,500,000 or the total depreciable amount, which is 1,550,000 less 50,000. So our total depreciation for the over the life of the asset should be 1,500,000. So in 2024, our depreciation should be the carrying amount for 2023 less the 50,000. Therefore, our depreciation is 150,880. This applies only, this computation only applies in the last year of the life of the equipment. So our total accumulated. Next, we're going to discuss the composite method. The reason why companies are using composite method is that they find it time consuming to compute individual depreciation. So they group their assets and use composite rate to depreciate all of their assets. So assets are treated, depreciable assets are treated as one. They also have one accumulated depreciation for all of these assets. Let's dive into our problem. So this Covita company used the composite method to depreciate all of its asset at 25%. Beginning of the year, 5 million. Accumulated depreciation, 3 million. Purchased equipment for the year, 3 million. Sold equipment for the year, 1 million. And it was sold for 200,000, though its residual value is 100,000. Two issues here that we're going to solve. We have to compute for the depreciation for 2020, and we have to prepare a journal entry on the recognition of this 1 million asset that was sold in December, end of 2020. Start. So again, based on our data, total cost of our asset, 5 million outstanding balance for the year. Then we acquired 3 million. Then we disposed asset for 1 million, the cost of the asset disposed. So the remaining cost on December 31, 2020 is 7 million. So this will be the base for computing the depreciation for the year. So it's 7 million times 25%, it's 1,700,000. So again, just like the double declining balance method, depreciation is based on cost. We multiply it by cost. So we disregard the 3 million accumulated depreciation in this case. So it's remaining cost times composite rate 25%. So our depreciation for the year is 1,750,000. Okay, so what would be our journal entry on the disposal? So we received cash 200,000, although its receivable value is 100,000. So you record what we received, 200,000. The cost of the equipment disposed is 1 million. So credit equipment 1 million. Under the composite method, no gain or loss is recognized on the recognition of an asset. So no gain or loss is recognized because the difference is charged to accumulated depreciation. So the difference of 800,000 is debit accumulated depreciation. Another depreciation topic. This time it's change in method. Sometimes the company may decide to change if they find that the depreciation depreciation method they are using is not appropriate depreciation method that they are using in their particular assets. Or sometimes it could be part of their depreciation policy where the earlier part has a different depreciation method and the later part of the asset has also a different depreciation method that is being used. So let's discuss change in method. Exmo company purchased an equipment on January 1, 2018, 8 million, 5 years life. It's part of their depreciation policy that first 2 years, 200 double declining balance, then switch to straight line for 3, 4, 5 years. In the third, fourth, and fifth year. Question is, how much is the accumulated depreciation for 2020 if the asset is purchased on January 1, 2018? Again, the requirement is accumulated depreciation. So you have this rule. Change in depreciation method is accounted for as a change in accounting estimate and therefore should be treated currently and prospectively, meaning we will not be touching the first 2 years of the depreciation that has been done using the double declining. We will discuss later in our succeeding videos about this prospective and retroactive terminologies. For now, let's proceed with our problem. So we compute the double declining rate by multiplying the straight line rate by 2. So 100% divided by 5 years useful life, that's 20%. So our fixed rate is 40%. So for the first 2 years, we purchased the equipment on 2018. So our first year depreciation is 3,200,000, which is 8 million times 40%. For 2019, it's 1,920 from 4,800,000 times 40%. This 4,800,000 here is the carrying amount. 8 million less depreciation for 2018, you have 4,800. So 4,800 times 40%. So you have 1,920,000. So our total accumulated depreciation is 5,120,000 prior to the change in the depreciation method that we will be using. So in 2020, we will use straight line. So our carrying amount now is 8 million less 5,120,000. So that's 2,880,000 divided by 3 years, the remaining life of the asset. So you will get 960,000. Again, this 960,000 is 8 million less 5,120. So that's 2,880,000. 2,880,000 divided by 3 years, that's 960,000. So that's what we do when we change in the depreciation method that we are using. So first, compute for the carrying amount of the asset prior to that change. Then divide the carrying amount by the remaining life of the asset. So our accumulated depreciation for December 31, 2020 is now 6,080,000. The 5,120 from double declining plus the 960 using the straight line method. So thank you very much for watching and hope to see you guys following us for more of our accounting tutorials, engineering, and mathematics. Thank you very much.